Okay, so in this video, I'm going to quickly give an introduction to options and how they work. So before we start, let's quickly look at forwards and futures. So these are contracts which trade in a market, which oblige a market participant to buy or sell one currency against another at a certain time in the future at a certain predetermined rate. So for example, you could buy 1 million euros of a euro-dollar future or euro-dollar forward with a settlement rate of 1.3. So what that means is that when it comes to the settlement date, you'll be obliged to buy 1 million euros against dollars at a rate of 1.3. So after you carry out this trade, you can immediately go into the market and sell the euros you've just bought at the market rate. So if, for example, the rate is 1.3 and you've just bought your euros for 1.3, you'll make no money. But if, for example, the euro-dollar exchange rate's gone up to 1.31, which means you can sell the euros for 1.31 and you bought them for 1.3, so you make a profit of $10,000 on that trade. So options are similar to forwards or futures, except that instead of obliging you to buy or sell a currency, you have the right, but you're not obliged to. So that's the only difference, but it turns out that's incredibly significant for the way these contracts trade. So options that give you the right to buy a currency against another are called call options, and options that give you the right to sell a currency against another are called put options. Of course, you're always buying and selling a currency against another one, so it's just a notational thing, really, the difference between a call and a put. A euro-dollar call is the same as a dollar-euro put. So, for example, if you want to buy 1 million euros a 1-month call option on euro-dollar with a strike of 1.3, what that means is you have the right to buy 1 million euros against dollars at an exchange rate of 1.3 in 1 month's time when the expiration date is, but it does not oblige you to do that. So let's look at this example. So you own a call option for 1 million euros for 1 month call option on euro-dollar, and the strike is 1.3. So when we talk about options, we go away from the settlement rate and we start referring to the exchange rate at which the contract is determined as the strike. So let's say we own this option and at the expiry the exchange rate is 1.31. So if we want, we can exercise the option, and what that means is we can carry out the terms of the contract and we can buy 1 million euros for 1.3. So if we do that and we start off with flat bank accounts, this will mean we'll have 1 million euros in our euro account and we'll be overdrawn $1.3 million in our dollar account. We can then sell 1 million euros and receive 1.31 million in the market if the exchange rate is 1.31. What that means is we will end up with a $10,000 profit from this trade. Therefore, it makes sense to exercise the option at expiry. Okay, now let's consider the case where euro-dollar's gone down since we bought the option, and it's gone down to 1.29. So as before, we can exercise this option and we can buy 1 million euros against dollars at the exchange rate of 1.3 as per the terms of the contract. So as before, we'll have 1 million euros in our euro account and we'll be overdrawn $1.3 million in our dollar account. We can then sell the 1 million euros in the market, and in this case we'll only receive $1.29 million from this trade. So what that means is when we flatten out our bank accounts, we'll end up with a $10,000 loss. So in that case, because this is an option and not a future or forward, we don't have to exercise the contract, so in this case we wouldn't do it. We would just have zero profit rather than a loss of $10,000. Okay, so this is the payoff of our call option at expiry. So if the exchange rate is 1.3 or below, and we're buying euros against dollars at an exchange rate of 1.3, it wouldn't be sensible to exercise the option because we'll make a loss. So in this case, we don't exercise the option, we just let it expire, and the option is worthless. Above 1.3, we're buying euros against dollars at a favourable rate and we can immediately sell them in the market and make a profit from them. So the line here going up shows the profit as a function of the exchange rate. Okay, so now let's look at put options. So put options are similar to call options except that they give you the right to sell rather than to buy. Okay, so let's take this example. You buy an option which gives you the right to sell 1 million euros against dollars at an exchange rate of 1.3. Okay, so let's consider the case where euro-dollar has gone up to 1.3 since you carried out the trade. So you can now exercise the option and sell 1 million euros for 1.3. So in this case, if you look at your bank account, you'll be left overdrawn by 1 million euros in your euro account, and you have a balance of $1.3 million in your dollar account. If you're then to go onto the market and try and flatten these accounts by buying back the 1 million euros, this would cost you $1.3 million to do this. So what that means is if you were to carry out this trade, you'd end up with a $10,000 loss. So for that reason, you do not exercise the option, you just let it expire worthless. Okay, now let's consider the case where euro dollar's gone down. It's gone down to 1.29 as before. So in this case, we can exercise the option if we want, and we can sell 1 million euros for 1.3. So we would end up with the same situation as before. We'll be overdrawn by 1 million euros in our euro account, and we'll have a positive balance of $1.3 million in our dollar account. If we then wanted to buy back this million euros, we can do it by selling $1.29 million in the market. And if we were to do that, we'd be left with $10,000 profit in our dollar account. So for that reason, you would exercise the option and take this $10,000 of profit. So similarly to a call option, this is the payoff for a put option on euro dollar. So above 1.3, it doesn't make sense to exercise the option, so the option is worthless. So any point at 1.3 and above, you say the profit from the option is 0. And below 1.3, you can exercise the option, then buy your euros back for a favourable rate and make an immediate profit. So this is the payoff of a put option. So because these contracts give you the possibility of making money, they are worth something and they cost money to purchase. So in reality, we showed before the profit as a function of euro dollar exchange rate, and we said it was flat at 0 up to 1.3 in the case of a call option, or above 1.3 in the case of a put option. But in reality, you would have had to pay something to start off with to buy the option. So for that reason, this is a more realistic description of the profit. So if you buy an option and you've paid some money for it, the payoff is actually negative until you get slightly above the strike in the case of call option, or slightly below the strike in the case of a put option. And the premium depends on a number of things, and we're going to go into that in the future videos. But some of the things that the premium of an option depends on is the current spot rate, of course, where it is. That just means how likely it is to be worth something in the future. The amount of time to expiry. The longer you have to expiry, the more the option's worth, because there's more the possibility of it moving. The volatility of the exchange rate you have the contract on. The more volatile the exchange rate, the more likely it is to move a long distance and hence potentially make a profit. And interest rates as well. So all of these things will be described in future videos, and an explanation of how the value of an option changes as you change the volatility, for example, will be described in the future.